Fox Corporation just lost roughly 1/6 of its entire market value in a single trading session. Not over a quarter. Not over a year. One day. For context, that is not a bad earnings miss. That is the market telling you that something it believed about this company's future is no longer true. The question is not whether 17% is a big number. The question is whether the market is right or whether it just handed disciplined investors a window. That answer depends entirely on understanding what broke today and whether it can be fixed. To understand a single-day 17% drop, you have to understand the specific catalyst, not the general narrative. Single-day moves of this magnitude in a large-cap company are almost never about fundamentals alone. They are about fundamentals colliding with positioning. Investors were leaning one way, and the news forced a violent reallocation. Fox Corporation built its post-cord-cutting identity around two hard assets: live news, anchored by Fox News, and live sports, primarily NFL, MLB, and college football rights. The investment thesis, going into 2026, was straightforward. Streaming killed appointment television, but it could not kill live. People still watch the Super Bowl in real time. They still watch election night in real time. Fox was positioned as the last network standing precisely because it shed its entertainment library and went all in on content that cannot be time-shifted. The catalyst that broke that thesis falls into a specific category: distribution risk. Whether the trigger is a major virtual MVPD, a streaming pay-TV bundle, threatening to drop Fox channels over a carriage dispute, a key sports rights deal coming apart earlier than the market expected, or a significant subscriber loss number that signals the live sports moat is narrowing faster than modeled. The market's reaction is the same. It reprices the durability of those cash flows. Here's the mechanical reason the drop is so large. Fox trades at a multiple that prices in stable, recurring affiliate and retransmission fees. Those fees are locked to distribution. If distribution is threatened, you are not just losing 1/4 of revenue. You are impacting the entire discounted cash flow model. Analysts do not lower their estimate by 5%. They pull up their spreadsheets and ask whether the moat still exists at all. That recalculation produces violent price moves. The actionable lesson here: when you own a company where the thesis depends on a specific structural advantage, you need to monitor the leading indicators of that advantage constantly, not just earnings. A 17% single-day drop demands a specific question: is this the market discovering new information and pricing it correctly? Or is this momentum and fear doing math that does not hold up? The answer, as usual, is somewhere in between. But the weighting matters enormously for how you think about the stock going forward. The case that the move is justified rests on the structural headwinds accelerating faster than the bulls admitted. Virtual MVPD subscriber counts across the industry have been declining. YouTube TV, Hulu Live, and DirecTV Stream collectively represent the replacement bundle market for cord cutters who still want live sports and news. If those platforms lose subscribers, or if carriage fees become a point of renegotiation, Fox's affiliate revenue, which represents a substantial portion of its total top line, becomes structurally impaired, not cyclically weak. A permanent impairment deserves a permanent valuation reduction. On that logic, the market may be right. The case that this is an overreaction rests on execution history and asset specificity. Fox News remains the most watched cable news channel by a wide margin heading into 2026. The NFL relationship, while expensive to maintain in rights renewals, generates live ratings that no streaming platform has yet replicated organically. Fox's debt load is manageable relative to peers, and its operating margins in the cable segment have historically been resilient. If the catalyst today is a carriage dispute, which are nearly always resolved because both sides lose money during a blackout, then the market may be pricing a negotiation as though it is a permanent loss. The honest answer for a retail investor is this: you do not have the information advantage here that institutional desks have. You do not know the exact terms being negotiated, the leverage each side holds, or the timeline. What you can do is size that uncertainty correctly. This is not financial advice, but a disciplined framework says you do not average into a broken thesis until you can clearly articulate what the recovery path looks like and why the market is wrong about the duration of the pain. If you are newer to markets, this FOXA move is a graduate-level lesson compressed into one trading session. Let me give you the 3 things worth internalizing. First, single stock concentration and thesis fragility are the same risk wearing different clothes. Fox was not a speculative biotech or a pre-revenue startup. It was a profitable, dividend-paying media company. But the entire valuation rested on a narrow structural argument. Live content is durable, and Fox owns the best of it. When that argument gets stress-tested, the entire stack gets repriced. Every single stock position you hold has a load-bearing assumption underneath it. Your job as an investor is to know what that assumption is before the market tests it. Second, heavy volume moves on bad news are more informative than calm drift on good news. When a stock drops 17% on volume that is 3, 4, 5 times normal, institutional holders are exiting at a loss. They are not trimming, they are making a decision. That tells you the thesis damage is not superficial. It does not mean the stock cannot recover. It means sophisticated, well-resourced participants who held through prior dips have decided the math changed. That signal deserves respect. Third, the difference between a value opportunity and a value trap is whether the core revenue driver is impaired temporarily or structurally. Legacy media has produced some of the most spectacular value traps of the past decade. Companies that looked cheap on earnings multiples kept getting cheaper because the earnings themselves kept shrinking. Before you look at Fox's current price-to-earnings ratio and conclude it is oversold, ask the harder question: what does the earnings power of this business look like in 4 years if distribution trends continue at their current trajectory? If you cannot model that with any confidence, the stock's apparent cheapness is not a margin of safety. It is an information gap dressed up as an opportunity. The market is not always efficient, but it is rarely wrong about the direction of structural change in media. Trade that insight accordingly. We opened with a simple question: did the market just get this right in one session? The data says the structural pressure on Fox is real. The move is not irrational. But whether 17% is the right magnitude depends on a carriage dispute resolution timeline that is still unclear. That uncertainty is the trade. Next video, we are going to look at which media assets are actually positioned to survive the next phase of distribution fragmentation, and which ones the market is still pricing too generously. If you think that is worth your time, subscribe. And drop your take on FOXA in the comments.